Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. We recently hit the 2-year anniversary of this current bull market, and the primary driver of the strong performance has been mega tech stocks, AI-related stocks, and more specifically, the Magnificent Seven. We are now embarking on a new investment regime as the Fed has started to cut rates, and some are predicting the economy will start to slow. Well, I have on the perfect guest to talk about this changing investment landscape and what it all means for dividend investing. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome back to Max Wasserman. Max is the co-founder and senior portfolio manager at Miramar Capital. Max, thank you so much for coming back on the show. It's an honor to have you on, and it's an honor that you wanted to come back on, and glad that I didn't scare you away after the first appearance.
Not at all. Great
perfect.
show. Great show.
Can you please just tell us a little bit more about yourself and Miramar Capital?
Sure. We're an SEC registered investment advisory located about 20 miles north of Chicago in a city called Northbrook. We manage high net worth individuals, small foundations, and corporations, and we build them individual stock and bond portfolios. And in our case, our stocks are usually, we run a portfolio of about 30 dividend stocks.
Okay.
So when we build them a diversified portfolio. And so our goal is really to outperform the market on a risk-adjusted basis over a 5 to 7 year period, which is great. My background has always been sort of like research and money management. So I used to do valuation studies, mergers and acquisitions in the early years, going back over 30 years ago. The gray hair is showing. And I've done it for multiple different firms. I've been a research analyst in the energy industry, the consumer staples. I've written in those areas. I've worked for Shearson Lehman. I worked for consulting firms like Ernst & Young in the background. And I've done LaSalle Bank. Was a portfolio manager there for years. And so our firm is almost 7 years old now.
Okay.
We manage about $550 million of assets. All fee based, and again, we're an SEC, so we're fiduciaries. So that great rule that we follow. I love Warren Buffett's comment. Rule number 1 is don't lose money. Yep. Rule number 2 is see rule number 1. So my background has been on valuation, building portfolios, looking at companies from the ground up. My partner, Robert Kalman, has owned a registered investment advisory for like 25, 30 years. And we merged our business together and created Miramar Capital. He liked the name Miramar because he was in Cuba, and there's a little city and it means ocean view. Me, on the other hand, I liked it because of the military base in California. And if anybody's seen Top Gun, you have Miramar as Top Gun, and I like the whole attitude of a beautiful view, but you protect. So we came up with that name. And we also like the fact that none of our names are on the firm. We want no egos. So him and I build portfolios, talk markets, and every single day, all day long, basically ad nausea, we go back and forth where we think the market's going to do, and we look at companies that make sense to us.
Fantastic. I love it. We could just talk. I have so many questions just about that opening statement. Number 1 is Top Gun. So who doesn't love Top Gun?
Who doesn't like? I mean, come on, right?
Yes,
Tom Cruise.
Exactly. Maverick. Interesting story. The end scene of Maverick was filmed here in Tahoe over the lake during the winter. So Tom Cruise was in town. There's all these jets, fighter jets, right. And it was quite the scene coming up when they started the scene. They didn't fly the fighter jet into Tahoe. They actually drove it. They hauled it onto it. So it took up, if anyone's been up to Tahoe, the roads are it's not like a highway.
Right.
But it's Top Gun's fantastic. Love
Oh
that
yeah, I
movie.
mean it's in Miramar, and my
Yeah.
my wife actually's nephew served at Miramar for a period
Oh,
of
very cool.
time. So I just look at everything as it's a great name, and
Yeah.
I like the name of it and keep it an ocean view, right? I mean,
Yeah.
I always tell clients we'll protect your assets, and one day we'll make sure you get an ocean view with all the money you make. You know, some cheesy things like that,
Yes.
whatever. Like can't beat it.
Uh, it's all the marketing stuff that wins, right? It's all those little
Yeah, you
marketing.
gotta give people a little smile,
Yes.
bang for the buck, as I say.
And I love also your backdrop with Miramar about protecting, right? I often think, and we're in the risk business, risk analytics, investment analytics here at Zephyr, and we often talk about standard deviation and volatility, but to me, the
Sure.
real risk is losing money, right? I don't care if volatility is up on the upside. It's that downside protection, exactly what you're talking about.
Yeah, I mean, if you think about it, people confuse volatility and principal loss. They really do. If you're going to be in the stock market any day, who knows what moves it? It could be international, could be the Fed gets a hiccup, somebody gets sick, they make a statement in China, right? There's a potential war, earnings from a major company spook people. You don't know from day to day, and that's volatility. Loss is when you really buy things you don't understand or the volatility spooks you to make a decision, right? I mean, when people don't understand volatility, people like to buy when things are high and they love to sell when it's low. I mean,
Yeah.
I don't care what anyone tells you of buy low, sell high. What happens is they get emotional, right?
Yes.
You have to work with clients and educate them to understand what volatility is. Now we do, that typical, not to get too technical, beta analysis, right? Markets one. You typically our portfolio over 7 years, somewhere around 0.77, zero point 0.8,
Mhm.
right?
Yeah.
And we always tell what it is. And the type of investors that we are is when the market goes way down, we don't, right? But when it goes way up, we won't go way up either.
Yeah.
But if you don't lose as much money on the downside, you don't have to make as much money on the up. And I look back in 22 when the S&P was down like 20%, the NASDAQ was down in the 30s. Our portfolio is down about 5.5%, which we know we love that. Now, conversely, when the market's up 30%, we'd be very happy if we were up in the low 20s, right? Again, it's just understanding what our portfolio is designed to do and sit in front of stock side. And on the bond side, the same thing. People don't realize in 22, for example, did the average bond portfolio lost anywhere from 7 to 15%, depending what it was, because rates went up so much. But we educate a lot. Volatility is your friend, but usually principal loss is because people don't understand volatility and or they don't understand their investments, right? They really don't realize what they bought, and the risks that go with it.
Interesting. I love that. That's fantastic, Max. And such a great way of putting it because if you protect more on the downside, you have more assets in there
Yeah,
to capture the upside, right? Even if
right.
maybe you don't capture 100% of the upside, if you still capture 80%, you still have more assets in that bank in the account to capture that upside. So
Yeah, I mean, think
fantastic.
about it. I always like the analogies, baseball players. It's great when you hit a lot of home runs, but if you strike out 100 times in a season, it's not that good. If you
Mhm.
can be a consistent, RBI producer, like,
Yeah.
get base hits and doubles, you're the most value to the team there is, right? Because you
Yep.
just, you're in the clutch hitter. And people like the glitz. They love, in the Magnificent Seven that you mentioned earlier, they love, oh, I own this one stock. Okay, great. It did well.
Yep.
What's the rest of the portfolio doing? We don't want to talk about that, right? We don't want to talk about that. I'm sure you have your $5 million all stuck in a video, right? I mean,
Yes.
it's like, that's what it is. And, people always tout the winners, right? But that's stock picking for the sake of conversation. But true money management, pure, true risk management of a portfolio is you look at, okay, I want the upside. I just don't want a lot of downside. And as you get older, by the way, you're right, you don't have that ability of time keeps, contracting, right? So time is your best friend in investing. The longer your time, it just, equates everything out. And now Albert Einstein was, correct when he said, compound interest is the best thing. But as you get older, you don't want to see your investments lose 20% a year, 15% a year. If you're 70 years of age, you're like, oh my God, you're right. Or even if you're 50 when you made a lot of money. So your company, do you want to walk out and get hit with a 20% haircut in the market? So, we really have to educate investors and what it means to be an investor, not a trader.
I love it. And education, personally, I think education in financial markets should start a lot earlier than just having you do it, Max. It should start in high school or, education. But
Yeah.
I love
I
it that
always,
you
you
just,
always say if, parents, if they bought one share of a stock, that old Disney used to be real popular for kids. Um, I used to take my kids shopping. I would say, you want to go to do homework with your father? And they go, what? Sure. I said, well, we're going to go to like the Walmarts, the Targets, the Costco's, and we're not going to buy a thing. So we would spend Sundays. What are the people buying? Right?
oh,
What do the cars in the parking lot look like? What's in the, what are they, when they go to the electronics, what are they putting in their baskets? What kind of groceries? Who's buying what? What kind of clothing? And you teach them that, and then you ask them questions. Which company looks like they're more successful today? Target, was Costco, was Walmart, was this? I mean, Nike a big seller. You
yeah.
teach kids to look at things and say, what's actually transpiring with people.
Hmm.
And there's a lot of written stuff on behavioral analysis,
Yeah.
which I'm sort of a big fan of, in the fact that people are very emotional, right? But if you watch them, you learn a lot.
Yeah. You're exactly correct. You're exactly correct. Max, you guys focus on dividend investing,
Correct.
investing in dividends. Well, we are embarking on a new interest rate regime, as I said at the open, as the Fed has finally started to cut rates after keeping interest rates at 2 decade highs. So how does, a new rate cutting cycle impact dividend investing?
Well, it's a great question, because when you look at it, people are retirees or seniors or people who need cash flow. They need to live off their investments, right?
Mhm.
When interest rates are like 5% in a 10-year and money markets are
Yeah.
4 to 5%, which what they are, people can put their money in a money market, get 5%, and they're like, I'm not really taking any risk.
Mhm.
I can buy a 1 or 2 year treasury and get 4 to 5%, and I don't have to worry about the markets, and I can live off 5% on my investments, right? I put $1 million, I'm getting 50,000. But as interest rates go lower, right? And it goes down to, let's say you're only getting 2% in the money market. Well, I'm not on $1 million, I'm only getting 20. I can't live off 20,000. So they start searching for yield,
Mhm.
right? And they say, well, that's great, because when the interest rates are going down, I want something that can pay me. So people start taking money and looking for things that are paying them better dividends, better cash flow. And that usually is bullish long term for dividend stocks, right? That, because it's sheer demand, it's a shift. So money comes, typical bond investors, for example, who wouldn't buy stocks, were buying dividend stocks, right? Bond investors who couldn't get 2% years ago, before the Fed raised, they were getting 2% into 10-year treasury. They took money out of bonds and they started buying dividend stocks, right? They became used to getting cash flow from dividend stocks. So I think it's a very bullish thing for dividend stocks when you have the shift. And also, it becomes an attractive alternative to money markets. And right now, we have a record number amount of money in money markets. So it's interesting.
Yeah, it really is. And like you said, for years, investors, they had to go, those income seeking investors, yield seeking investors, they had to go outside their typical traditional yield yield investments. And like you said, whether that was dividend stocks or even outside of that, more alternatives and
Oh,
stuff
sure.
like,
MLPs, master
yeah.
limited partnerships, they started getting involved in, and they got hurt in that area, by the way. They got
Mhm.
a lot of investors years ago got hurt there. Or they looked for ways to hedge in terms of enhance. They would write covered calls, and
Yeah.
all these strategies came out. And investors really didn't understand what kind of risk they were
Mhm.
taking in these things. But when the Fed starts cutting interest rates, a shift takes place in the mentality of the investor. Where can I get my cash to live off of? Not
Yeah.
just, I buy a stock, because remember, when you buy a growth stock with no dividends, you don't make money.
Yeah.
Even if the stock goes way, way up, right? Let's say the stock goes from 100 to 200. I made $100 on the stock. No, you didn't. You only make it when you take it out. So you got to sell that position, right? So yes, on paper it looks good, but I can't live off that. I can't go to the grocery store and say, listen, I own Nvidia at hundreds, $200 a share. Can I have, that steak over there? No. But with a dividend stock, when you buy it at 100, maybe it goes up to, maybe it goes up to 120, 150, but it's paying you cash.
Hmm.
And each month or each quarter, you're receiving cash. And now with cash in my hand, I can buy more of the stock, or I can go buy that steak at the grocery store. But it's actual money paying to you to do whatever you want. And that is an important aspect for people who live off their investments.
Yeah, exactly. You kind of mentioned trends too, and what happens in this space, dividend investing during different interest rate regimes. What are some long-term trends that investors maybe aren't looking at closely enough when it comes to yields and dividend stocks?
Well, I think what they do is sometimes they just buy the absolute highest yielding investment, the
Mhm.
highest paying dividend, if you will. They really don't understand why it's the highest paying dividend. We like dividend growth investments. We like companies that pay maybe they're not paying 5, 6, 7, or 9% in these areas. And maybe they're paying 3 to 4, or even 2, but they're growing the dividends at 7 to 10% a year. So I think what they do is sometimes they get focused on the absolute number, not on why it's the absolute number. And there's a lot of risk when you go into dividend investing if you focus just on the absolute number. We've seen dividend cuts. We've seen companies just can't afford to pay it. So the trend is, we always say, when we look at dividend investing, typically they all went to utility stocks. Give me utility stocks, give me energy stocks, right? Or
Mhm.
give me those old dingy Dow companies, right? They used to be. But that's not what it's become. What it's become is there's other areas of the market that play healthy, growing dividends. Even the big technology companies now are paying dividends and paying lots of them, right? So we would say the trend is people need to focus less on the absolute number on the top and more about the quality of the company and the dividend growth rate of what it's doing, and can they afford to keep paying you the money,
Mhm.
right? I mean, if you borrow money from a friend and it doesn't look like they can pay you back, they can promise you the world, right? But they don't deliver. So
Mhm.
look for good growing dividends, and there's a lot of good companies. Look at dividend stocks now infected the Magnificent Seven, right? It just has. I mean, all of a sudden, Microsoft, Apple, Google is now paying a dividend, right? Meta is now paying dividends. So a lot of these tech stocks, they're paying record amounts, but the yields aren't high.
Mhm.
But they're good investments and they're giving you cash flow. So we would tell the trends is, don't look at the old trends of just buying utilities. Look at dividend growing, and you can find them in industrials, healthcare,
Mhm.
all other areas in the market that can really round out a portfolio.
Yeah, although I often say, today's market, for numerous reasons, isn't like your grandfather's market from years ago, right? You can get dividend stocks and dividend growth in other parts that traditionally weren't dividend paying. So when you look at dividend growth, do you look at it over 3 years, 1 year, 5 years? Is there like a time period that you
Right.
look at that growth over?
Well, first, I want to look at what's the policy of the company, right? Are they committed to a dividend, right? Is it just a token? Are they still? I look at the 1, 3, 5 year growth rate, right? So I look at the 5 year and I see where it is on the 3 year and the 1 year. Is it accelerating over the 5 year average? Is the last year accelerating? Is it deaccelerating? So I want to see that, and I want to see the payout ratio. Payout ratio is what percentage of the earnings are being given to to cover the dividend that they're paying out. So if I earn $1 in earnings, am I paying out, you know, 25 cents? Am I paying out 50 cents? And I want to see that payout ratio. So
Mhm.
it's also the payout ratio. We want to see a payout ratio that's not going really high. We don't want to see them paying out all the earnings, but a good portion of it. We want to see a dividend policy, but we want at 1, 3, and 5, obviously giving more weight to the more current,
Mhm.
dividend rate, but we want to understand the policy of the company. What's their commitment to the dividend? Is it a growing dividend, right? And we look for companies, we do a barbell strategy, and I get too technical for our, meaning we have higher paying dividend stocks, let's say 4 or 5%, maybe even 6 at times. And we have some that are playing like 1%, right?
Mhm.
And we target on our portfolio, we try to target around a 3% dividend yield on our portfolio,
Okay.
and we try to target a dividend growth rate of 7 to 10% on the dividends. Now, it changes because,
Mhm.
as the market changes, right now, maybe we're getting about 2.7% yield on the portfolio. But we're looking for trends in dividend growth. So 135 is a good number, and the payout ratio is a really good indicator.
Mhm. Interesting. You mentioned it earlier about demographics and people who are getting older, they want income, they need income and more downside protection. My guess, we've talked a lot about demographics on this show. More so though on the other side regarding the wealth transfer and connecting with younger investors. But there's that other side of the coin, and America is aging. And still baby boomers own majority of the assets, so we have to consider that. And how is the aging Americans impacting the investment environment and dividend investing, more specifically?
Well, it's huge, but you have to go back in time. So you used to have a workforce. I don't know if you can see my hands, about this
Yeah.
big, right? And it supported an aging population of this big, right?
Mm.
Now you have a workforce of about this big, and the aging population's the opposite, right? So you have less money supporting, the
Mhm.
elderly. And here's the other thing: the length of time, longevity rate of people used to living like this are now there, right? So people are living longer and they're retiring longer. So historically, people made the majority of their money in their 40s and 50s,
Yeah.
right? That's where their income, corporate world used to pay in their 50s. Now they're retiring in their 60s, but they're living to 90.
Yeah.
They're more active. So their investments have to last longer, right? So a time frame has gotten, even for the retiring, has really expanded tremendously. So somebody who's retiring at 70 has to still live off their money for another 20 years. Think about that. So they need growth even at that point. The effect that you're seeing though is with this wealth transfer is people in their 50s are seeing this. They're seeing I want to retire, and I'm gonna retire longer, and I need my assets to last much longer than they ever used to. So I need to grow those assets. So the young people who are getting it, and my advice to them, and I know you've given it to them and everyone, is you better save. And you better save a lot, because thank God for the technology and medicine and everything. People are living longer and they're healthier because knee replacements, body, you're playing golf in your 70s. So you need more money because you're going to retire longer, and you need those assets to grow. So, but the retirees, they're living longer. They want those assets to produce. And that's forcing them into income paying stocks. Excuse me. It's forcing them to buy dividend stocks because they know I need cash longer.
Mhm.
And if I start taking all the principal out, I won't have enough because I'm going to be living for another 20 years, right? So the demographics have changed. The wealth transfer, all of a sudden, you're having a lot younger people again inheriting a lot of money, right? And it's flashing. Maybe I'll go buy that car quicker. But they need to be educated that yes, you have money, you can lose it very quickly.
Mhm. You're exactly correct. Education, right? You've mentioned that numerous times, how
Big fan
important
of it.
education is. You know, I mentioned at the beginning, not only are we in a new interest rate regime, some people are forecasting an economic slowdown moving forward too, hence the cutting cycle. But how do economic cycles impact dividend investing? Should we just, kind of always just invest in dividends regardless of the cycle? Does certain cycles benefit dividends more so than other?
Sure. Again, so I'm going to bias, so I'm going to say that old phrase, "talk your book," right? But I'm going to say here's look at this number. Since 1928, right, the S&P's return, about 42% of it's been dividends. So if you look at the total return of the S&P 500 since the 1920s, right, it's been about 42% of dividends is comp. Now, in the roaring 90s, right, when you had that, dividends maybe composed maybe 20% of the total return. If you go to the 2000s, maybe dividends were 60% of the total returns because nobody was making money. So dividend investing, I believe, is always going to be there. But the composite of your portfolio, like I said, barbells, when the economy's starting to grow, right, and inflation's heating up, you may want more growth oriented companies. So maybe you emphasize lower dividend yield, higher growth. And when the economy's slowing down, you want more protection. Maybe you're going for more stable, higher yielding, less growth. So the economic cycle affects it, but it doesn't shouldn't make you change majorly to your portfolio. But you what you'll emphasize maybe on the portfolio may be a little bit different. Like maybe you want more growth, less, less yield. Maybe some areas you want less growth, but higher yield. And that will be what the economic cycle is. And but transitions in the cycles, trying to predict it, it's a fool's game because nobody knows for sure when it's going to change. But you do know one thing. The Fed, when they cut interest rates, and I just want to caution everybody, the Fed is always wrong. Always. Fed is wrong. I mean, and market pontification, guys like me, 99% of the time are wrong, right? They don't nobody wants to say it. We're wrong, right? Everybody predicts, and the Fed has predicted more slowdowns and more expansions than we ever get. So all you want to know is actually what they do, right? Not what they say, what they do. And when the Fed is cutting interest rates, it's usually not one cut and done. It's a trend they make. And so, yeah, the economies, when they slow down, the Fed likes to stimulate by cutting interest rates. So that will start a whole new trend. We believe that, right now the Fed funds rate is roughly around 4.8. The Fed claims, I say they claim that inflation's under 3%. So usually a neutral rate is when the Fed funds and the neutral rate are the same. So that means if you have a 4.8 Fed funds and you have inflation at 3, you can cut 180 basis points. Now, when they do it, I can't tell you.
Yeah.
The Fed may go 50, 25, whatever they want to do, but it changes the direction of where rates are going. And now the Fed is making money cheaper, right? And eventually, short-term money markets will start coming down from that 5.4. They'll come down to 3. They'll come down to 2. And that would make your investments more valuable if they're paying you cash at a higher rate.
Mm-hmm. Love it. You mentioned the Fed is always wrong. The
Always wrong.
market, we're bad at forecasting. I mean, we've been expecting a recession for the past 3 years, right? The
Yes.
2 years,
Yeah.
the
Inverted yield curve is predicted.
inverted, and we're like, well, here comes a recession. It still hasn't arrived. So,
Well, you have deficit spending. I mean, keep in mind that this is an unusual time. It really is. I mean, COVID transformed everything. The world printed money. The world, not just us. The world did. And now everybody ran up big deficits, massive deficits. Well, you got to finance that, right? You got to pay that interest. So the Treasury, US Treasury did an interesting thing when the COVID, they financed all this stuff with short-term rates. Now you would think they would have went long 20, 30
yeah.
and given all that money and gotten it out at 2%, 2.5%. They did. So now when the economy's slowing down and interest rates are high, how are you going to pay for that? So the Treasury sort of got us in a mess because we have such huge deficit.
Yeah.
We got to pay that interest. So the Fed wants to cut it and make our interest costs lower. And that way the Fed can roll over their debt at lower rates. So that's what I'm saying. They're always wrong because the Fed always predicts something, right? It's like it's going to rain. Have you seen the weather, man? I mean, I never weather. I can't understand. When did the weatherman ever? Well, there's a 50% chance of rain. I mean, I don't know. They do it, but it's like the Fed. The Fed has called it wrong every time, basically, and that goes back to pretty much every Fed chair. They live in an ivy tower. But look at what they do. And right now we have heavy deficits. Interest rates are still relatively high. The real rate of return, that's the difference between the Fed and inflation, Fed funds rate and inflation, and they're high. So if the Fed says, and we'll believe them, right? They want to be neutral. That means they have to cut.
Yeah.
And as cut, interest rates come down the short end. Remember, the Fed controls the short end of the yield curve, not the long end. So as they cut, money markets and all those things CD rates are going to start coming down. How fast depends on how they cut, but they need to come down. Once they come down, then those dividend investments, those cash flow investments are worth more to you.
I often talk about if you're a Fed watch or exactly what you just said, watch what they do. It's the pace of the rate cuts. How
Yes.
steep are the rate cuts? That is a better signal of what to expect moving forward or what's going on now than some language
No.
or the dot plots or whatever the
Oh,
Fed is
yeah. We're
producing.
data dependent. Okay. I don't know. It's like,
Yeah, of course they're data dependent, right?
I mean, who isn't? I mean, but we're data dependent. All right,
Yeah,
you know.
exactly. We've talked a lot here. You kind of mentioned it throughout this conversation about, when it comes to dividend investing and investing in stocks with dividend growth, what are some misconceptions of dividend investing?
Well, I think some misconception is that the company is basically becoming too mature to grow. So they're
Mm.
taking all the money, the earnings, and they're going to pay it out because, we can't do a better return. In some cases, I think that's legitimate, but in a lot of cases, it's not because companies want to appeal, they want their stock to appeal to shareholders, right? And the world has become value investors, growth investors. Mutual funds have mandates. And so if you throw a dividend in on a growth stock, then dividend investing mutual funds can buy it, right? I mean, that's what happened with Apple, Microsoft.
Okay.
They threw a dividend, and all of a sudden, a whole new class of shareholder can come in. Are they real dividend companies? Not in the beginning. Who knows? You have to find out. But that's one thing. That's a myth. I think the second myth is that to get dividends, you have to go into utility stocks only. Everyone keeps saying when they look at a portfolio, I don't want to just own utility stocks, and that's what dividends are. No, I mean, there's great semiconductor companies that pay big dividends. There's industrial companies, financial companies. So they got to open that up. And I think the other thing is just because they pay a dividend doesn't mean the company's safe,
Yep.
right? That's another myth. Everybody says, oh, they pay me. It's going to be there. They're never going to cut the dividend. We've seen those dividend aristocrats, that famous term
Yep.
for people who have years of it. We've seen a lot of those fall by the wayside in the last couple of years, right? They couldn't afford to keep it up. They've cut those. I mean, companies, like Boeing, Disney, Walgreens. I mean, I'm naming major companies who've had to change dividend policies because of the economy and their own mismanagement of their company.
Mhm.
So that's a thing. And then the other big thing, young investors make a mistake. That's dividend investing is for my parents, not for me, right? That's my parent. I want to roll the dice. So, and that's a myth, right? You can get a lot of growth, a lot of good total return on a dividend portfolio equal to an all growth portfolio over time with less risk. But that's a myth. So many young investors goes, I don't want my father's portfolio. Give me, biotech, give me this.
Yeah.
And I would argue there's biotechs that pay dividends, right? So, but it's people how they look at it. They associate with the old stodgers, right?
Interesting. And what you said too, what I love about maybe years ago, if you buy a dividend portfolio, it's heavily concentrated maybe in utilities or
Right.
telecom or something like that. But now, like you said, you can get a dividend portfolio that is so much more diversified, right,
Yes.
in terms of the sectors.
And higher yielding. I mean,
Mhm.
you just can. I mean, you have great healthcare companies paying anywhere from 2 to 5% dividend yield. You have energy companies that pay you. Oil and gas pipelines pay you a lot.
Mm.
Technology. I mean, I own the company, so it's not to talk stocks, but individual. But you take a company like Broadcom was a huge dividend payer. I mean, they grow those dividends. Microsoft, Apple now is a big dividend payer, not a big dividend growth payer, but a big dividend payer in terms of how much they spend of their company. So you can get those across the board, right? So if you look, you can find in every sector good paying dividend stocks that are growing. And every time somebody looks at our portfolios, they say, you don't own a utility stock. No, we really don't. We don't own one. We do own a telecommunication, but no, we don't. It's not that I haven't owned them, right? But I don't. And the other thing I think people need to know about dividends is our taxation.
Okay.
People don't understand dividend taxation, right? There's difference between qualified dividends and ordinary dividends, right? So most people, when they buy a real estate investment trust, a REIT, they don't realize that comes in as ordinary income. So it's
Mhm.
tax your ordinary tax rate, right? Master limited partnerships, anything that's a limited partnership or a REIT is basically taxed at ordinary. Most companies, though, pay qualified dividends, meaning you can pay them at a lot lower rate. Instead of paying them at 40%, maybe you're paying 20 or 10%
Mhm.
dividend tax. So again, look at not all dividends are equated. They're different tax rate on
Yeah.
each type. And we encourage people to understand the tax of the dividend, and whether it's qualified and ordinary income.
Yeah, I'm really glad you brought that up because that's a very important part is, we're talking so much about taxes lately and managing your tax liability. Such a great point. Max, thank you so much. I always enjoy having you on. It's such a
My
fun
pleasure. It's great
conversation.
seeing you and talking to your group. So I love it. I
Yes.
look forward to it.
I always get a good chuckle whenever we're on and enjoy it so much. It's an honor to have you on. Where can our audience get more information about Miramar Capital?
Sure. If you go to miramarcap.com, right? So you're gonna make me spell it MIRAMARCAP.com. And on there, we actually put together videos,
Okay.
like a minute and a half videos on dividends, like 3 or 4 of them, short ones that say why dividends should be in your portfolio, growing dividends. And our website, we have a ton of educational material. Because as you know, I'm a big believer in educating the investor. I think all investors should understand what they have money in. It's their money, right? Don't trust a guy who comes, right? Don't trust, verify, right? As they always say, verify and understand your investments,
Mm,
right? If somebody who manages your money can't explain it to you what you own, there's a problem.
yes.
You should be able to understand all your investments. But go to miramarcap.com if you would. I appreciate it. And just look at the videos. They're entertaining. We wrote them to make them entertaining. A minute and a half each. Won't take much.
I like I, I love going to websites before conversations, see what's going on, what's the message, and you guys produce some fantastic content, education. I love it. Go there often. So yes,
Thank
I
you.
recommend
Thank
all of
you.
our viewers to go there also. And I will
Thank you,
put your
Ryan.
website in the show notes as well.
Thanks so
Thank
much.
Yep. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.